markets are rallying in the view that President Trump will back off from the worst of his tariff threats, that economic growth will remain steady, inflation will stay calm, and that central banks can keep cutting interest rates as a result. In America, the world's biggest stock market, all of the losses suffered in the wake of Liberation Day on the 2nd of April have been regained, and indices such as the S&P 500 and Nasdaq Composite are approaching the all-time highs that they reached in late 2024 or early 2025. One source of that rally has been the so-called Magnificent Seven of Alphabet, Amazon, Apple, Meta, Microsoft, Tesla, and NVIDIA. Their total stock market capitalization of 16.8 trillion US dollars is within 10% of the peak reached on Christmas Eve last year, and more than a quarter above the low that was reached on the 8th of April. However, they're not quite back to the past high yet, despite tariff exemptions in some cases, and it may just be that investors continue to ponder the implications of January's launch of its R1 large language model by China's DeepSeek. The product challenged the consensus view that artificial intelligence required more chipsets, more computing and server power, and more energy. And in some ways, AI-related stocks have yet to fully recover their poise as a result. Supermicro Computers dished out a profit warning and even written down the value of some of its inventory, while CoreWeave disappointed with guidance for the next quarter when it released its maiden quarterly results earlier this month. Not that I must admit the share price really cared. The stage, therefore, is set for the first quarter results from NVIDIA, which are due on Wednesday, the 28th of May, and will cover the 3 months from February to April. NVIDIA is the world's second biggest company by stock market capitalization, as I sit here, so it'll be an interesting test for the stock on several fronts. Now, some may accuse NVIDIA of gently sandbagging its quarterly forecasts, but it does have the happy knack all the same of beating estimates for the quarter, and they this time will be benchmarked against the guidance given by Chief Executive Jensen Huang back alongside the full year results in February. Just as important will be any guidance for the second quarter that's just started, and that runs from May through to July. So for the first quarter, NVIDIA is expected to have sales of $43 billion, some 70% above the $22 billion achieved in the same period a year ago. The analyst consensus forecast for the second quarter is $45.4 billion. Guidance for gross margin in the first quarter is a range of 70.6 to 71%. That's down from 78% a year ago and implies that cost of sales will more than double year on year. Again, hence the accusations that Mr. Huang may just be sandbagging the numbers. Add in operating expenses forecasts of $5.2 billion, other financial income of $400 million, and a tax rate of around 17%, and you get to the forecast headline earnings per share number of around 88 cents a share for the first quarter. That compares to 61 cents a share a year ago and implies a net profit of around $21.4 billion, below the outcome of the fourth quarter, which again some may think is conservative. For the second quarter, by the way, the consensus earnings per share estimate is exactly $1, up from 68 cents in the same period a year ago, and that dollar would equate to net income of around $23.4 billion. More strategically, analysts will doubtless look for comments from Mr. Huang on tariffs, America's restrictions on Chinese buying of leading-edge silicon chips, and also NVIDIA's planned ramp-up of the Blackwell data center chipset, where there have been reports of teething troubles. There are two other numbers that are worth watching, though, especially in light of Supermicro's profit warning. Remember that analysts used to say Supermicro was a good proxy for demand for NVIDIA and AI-related chipsets, a comment we've heard less frequently of late, especially after the resignation of Supermicro's auditor, delays in the releases of its quarterly regulatory filings, and write-downs against the value of the inventory in its balance sheet, presumably older generation chipsets. Now, if a company's big customers have got too much inventory, then the danger is, at some stage, demand from that customer starts to slow. And that's a trend that can show up in the supplier's balance sheet via both inventories and trade receivables. NVIDIA had to work through an inventory bulge actually back in 2022, and that did take its toll on profit momentum then. However, the company's done a good job since. Inventory may be rising in dollar terms, but given the strong sales growth, that's hardly a surprise. And inventory days are back to pretty normal levels by historic standards at around 87 days. However, accounting wonks will note the way in which trade receivables are rising quickly. This relates to revenues possibly booked by NVIDIA but where payments not yet being received. NVIDIA's own website offers detail on the customer funding it provides, given the pretty expensive nature of its products. Investors with very long memories will remember how Cisco and some internal internet equipment giants provided so-called vendor finance in the late 1990s, and how that helped to boost demand near term, but exacerbated the slowdown that followed as an investment boom turned to bust. Now, again, NVIDIA's sales growth is currently so rapid that days receivables are not actually massively above historic norms, although they are higher at 198 days against a 5-year average of 157. There could be trouble ahead if customers do start to slow their purchases for any unexpected reason, although, of course, at the moment, the share price clearly doesn't think that's going to be the case. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.